$1.35. I mean, it might just sound like pocket change, right? But in the world of high-stakes banking, that single number represents an absolute home run. That is U.S. Bancorp's earnings per share for the second quarter of 2026, marking a massive, record-breaking 21.6% jump year over year. When a bank of this sheer size posts that kind of leap, you kind of have to stop and ask, what exactly is fueling the fire here?
Welcome to This Explainer. Today, we're taking a magnifying glass to the Q2 2026 results for U.S. Bancorp. It is genuinely fascinating to see how a massive institution doesn't just meet expectations, but literally shatters them. So we're going to unpack the exact strategy and the specific acquisitions that made this happen.
Okay, let's dive into this. Here is our roadmap for today. We'll start off with the Q2 scorecard, look at the major BTIG acquisition, explore their payments transformation, break down their consumer and business ecosystem, and finally, we'll examine the solid risk foundation holding the whole shebang together. Starting us off, Section 1, the Q2 2026 scorecard, record revenues and growth. The underlying metrics here are just incredibly strong. Compared to the second quarter of 2025, net interest income is up an impressive 7.5%. But look at fee revenue. No way around it, it surged by 13.2%. This wasn't just some lucky break. This was broad-based fee momentum combining perfectly with robust loan growth across the board. And they managed to do all of this while keeping their efficiency ratio at a very healthy 57.1%. That's actually an improvement of 210 basis points from last year. Basically, for every dollar they earn, they are keeping more of it in their pockets.
So that efficiency improvement brings us to a really critical concept, positive operating leverage. In plain English, this just means the bank's revenue is growing noticeably faster than its expenses. U.S. Bancorp reported a massive 400 basis points of positive operating leverage. They are successfully walking this tightrope of keeping their expenses on a strictly disciplined leash while still targeting investments into future growth. They are essentially making way more money far more efficiently. And, overall profitability is just on a fantastic trajectory right now. Return on average assets sat at 0.97% back in the second quarter of 2024. Well, flash forward to Q2 2026, and it has soared to 1.26%. That is a fantastic leap, placing them perfectly, and I mean perfectly, into their medium-term target range of 1.15 to 1.35%. The bank is absolutely firing on all cylinders here.
Moving right along to Section 2, the BTIG acquisition impact, accelerating capital markets. Now, what's really interesting about this is how the acquisition of BTIG closed exactly as planned on June 1st. BTIG brings phenomenal equity trading and investment banking capabilities to the table, and this is like a giant puzzle piece falling into place because it perfectly complements U.S. Bancorp's existing strength in fixed income, currency, and commodities. It creates this total powerhouse suite of corporate services. And the financial impact? It wasn't some distant promise for next year. It was immediate. With the deal closing on June 1st, BTIG contributed roughly $98 million in record fee revenue to U.S. Bancorp in just that single month of June alone. I mean, that is a phenomenal starting gate for this newly integrated team. When you actually look at the scale this adds, it's a total game changer. BTIG brings over 700 employees, access to over 50 markets, and delivered a 14% pre-tax margin in June alone. So currently, capital markets represents about 7% of U.S. Bancorp's total revenue. But with BTIG fully in the fold now, their explicit target is to push capital markets to over 10% of total company revenue over time. It's a massive, massive growth lever for them. All right, Section 3, accelerating payments transformation, a 23% revenue engine. Listen, payment services isn't just a side hustle for them. It accounts for a staggering 23% of the bank's total revenue. In Q2 alone, that equaled $1.8 billion. Breaking that slice down, card issuing is the biggest driver at 14%, followed by merchant processing at 6% and corporate payments at 3%. What's really standing out this quarter is the accelerating momentum in card issuing and an incredibly strong rebound in corporate payment systems. And this brilliantly illustrates the resilience of a highly diversified bank. Even though they noted some softness in European merchant processing this quarter, overall, total payment services revenues still grew by 5.7% year over year. When one area sees a slight dip, the momentum in areas like card issuing and corporate payments steps right up to make up for it, actually accelerating overall growth. On to Section 4, Consumer and Business Strategy, the interconnected ecosystem. The sheer scale of their reach is, well, it's staggering. They serve roughly 13 million consumer customers across 2,061 branches and 55 client centers. And surprisingly, 18% of those customers are entirely outside their physical branch footprint. Absolute proof that their digital tools are winning people over from afar. But they aren't abandoning physical locations at all. They're still committing $300 million annually to branch investments, specifically targeting high-growth markets.
But here's the thing. Having 13 million customers doesn't actually mean much if they only use a single product. That's where this vital number comes in, 42%. That is the percentage of their base that are considered multi-serve clients, meaning they have deeply integrated relationships using multiple products across the bank. This is up from 40% in 2024. Deepening these relationships is exactly how they monetize that massive reach we just talked about. You can see the success of this ecosystem strategy directly in the product balances. It's like a giant flywheel. Their U.S. Bank Smartly platform for consumers has amassed over $84 billion in balances. Meanwhile, their mortgage-led deepening strategy has generated over $5 billion in deposits. By connecting branches, digital tools, and targeted products, they've actually driven a third consecutive quarter of record consumer deposits. Everything just naturally feeds right back into everything else. Okay, let's move to Section 5, the Solid Risk Foundation, balancing growth and safety.
The balance they are striking here is textbook perfect. On one hand, you have aggressive growth. Total average loans hit $410.3 billion, which is a 7.1% increase year over year. On the other hand, their non-performing assets, which, are essentially loans that are in default or dangerously close to it, actually decreased by 11.9%. Honestly, growing your loan book by 7% while simultaneously dropping bad assets by almost 12%, that is the absolute holy grail of bank management right there.
To further prove this safety, let's look at the net charge-off ratio. Think of this as the percentage of debt the bank believes it will literally never recover. U.S. Bank have reported a spectacularly low ratio of just 0.53%. This number translates all that corporate banking jargon into plain English. It proves they're lending their money very, very safely, even while growing their total loan amounts at a super rapid pace.
And wrapping up this financial fortress, their capital levels remain incredibly robust. They boast a 10.8% CET1 capital ratio, which is essentially the bank's core safety net of high-quality cash, and a 14.4% total risk-based capital ratio. Because they are so well capitalized and executing so efficiently, they were actually able to return over $1 billion, that's right, $1 billion, in earnings to shareholders this quarter. Improving asset quality and having rock-solid capital are for sure the true bedrock of this entire success story. So the crucial point is this. U.S. Bancorp didn't just stumble into a record quarter, they engineered it. They did it through disciplined expenses, strategic acquisitions, and a highly interconnected product ecosystem, all while managing risk flawlessly. But as we look ahead to Q3, with the BTIG integration kicking into high gear and $300 million in branch investments continuing to roll out, the real question is, how will U.S. Bancorp sustain and potentially even accelerate this massive, record-breaking momentum? It's a fascinating question, and we'll be right here to explain the answers when the next numbers drop. Thanks for joining me on this explainer, and keep on learning.